Good morning, everybody. It is October 9th, about 5:30 a.m. Central Time as I speak. I'm joined this morning by Brian Split, and it just so happens to be Brian's birthday. So, Brian, what kind of birthday wisdom do you have for us on this 30th birthday of yours?
Oh, you're going to ask me for wisdom first thing without even
Yes.
telling me?
Yeah, put you on the
Um,
spot.
shit. Swear more than you think you should. People actually like it. No, I don't know. I think things I just try to focus on lately in my life are just finding ways to be happy and not focus on some of the day to day, stuff going on in the world, all the headlines that are out there. And here we are talking about headlines,
Yeah.
but sometimes you just got to put that stuff down and really focus on what's going on in your day to day and not get caught up in the whirlwind of all of the big picture stuff going on in the world. Because I just don't want to sound like my grumpy uncle when I was a kid. Like, why is he angry all the time? Right? So
Perfect. Some great words to start the morning off with. With that, we will dive into the headlines. We're going to start off with Brazil's record soybean exports. According to Brazilian Grain Export Association ANEC, Brazil's soybean exports are expected to reach 102.2 million metric tons by the end of this month, surpassing the previous annual record of 101.3 million metric tons set back in 2023. The surge in shipments is being fueled by robust Chinese demand as the country increasingly turns to Brazil for supplies while avoiding U.S. beans amid the ongoing trade war. So far this year, China has accounted for nearly 80% of Brazil's total soybean exports. Supported by a record harvest, total Brazilian soybean exports this year are slated to reach 110 million metric tons. So it seems that China no longer needs U.S. soybeans. So even if the US and China do reach a trade deal, can we really expect China to return to the US market after establishing such a steady flow of beans from Brazil? And can Brazil really supply all of Chinese needs? China's needs, excuse me.
well, there's a lot of questions all at once,
Yes, it
Mackenzie,
was.
and
Sorry.
I think there's some positives and negatives in this general story. Negative, obviously, is that China has not been buying U.S. soybeans, and maybe that something is changing there. We'll get to that in a little bit. But the positive here is that Chinese demand for soybeans is strong. They've had record imports for 4 months in a row. So their month to month buying is extremely strong. Again, the negative is that it just hasn't been from the US. Now, I think there's a lot of, thought about how, the soybean market broke in value during the first trade war. And I think most that are not, in the market day to day would just immediately blame that on the trade war and President Trump. However, if you really dig into why soybean values dropped precipitously during the first trade war, a lot of that was because the Chinese culled about half of their hog herd due to disease, and there was just not the demand that there was, right? And so now we think about what's going on right now, and I think there's a belief that, hey, China can just live without the U.S. now. And maybe that's the case currently when you had two record soybean crops out of Brazil back to back. However, this is a commodity market, and Brazil will need to grow another crop this year, and then they will have to grow another crop the following year. And the idea that China just permanently can live without U.S. soybeans is very ignorant to the idea that this is a product that we can also have a poor crop out of Brazil. And if that happens, the Chinese will have to turn to the U.S. to get soybeans, right? So this is not something where you can just have record crops year after year after year after year after year, and China just says, "Oh, we're just going to buy Brazil." At some point, Brazil has a problem. Maybe it's La Nina, they have a drought in Mato Grosso, whatever it is, and they'll be right back in for U.S. beans. And maybe it's sooner than that. We'll talk about that.
Right. So, a bit more on beans. U.S. farmers are facing a soybean storage dilemma. Hot, dry weather has accelerated harvest progress, leaving many farmers either nearly finished or close to completing their soybeans. With China yet to purchase any U.S. beans for the current marketing year, supplies are quickly building up. Farmers now face a difficult decision: pile excess soybeans on the ground under tarps and risk spoilage while waiting for demand to improve, or sell the crop at deeply discounted prices. Up in North Dakota, this year's soybean crop is projected to exceed available storage by 33%, with surpluses of 26% in South Dakota and 15% here in Nebraska. What are your thoughts on this situation and the best possible option for farmers who are facing limited storage?
Right. Well, so you kind of had mentioned, three states that seem to have very solid soybean production, and those states specifically will potentially outproduce the local storage capabilities. If the producer does not have storage on farm, you have a limited amount of decisions to make, or amount of options. One thing that maybe in some areas has been positive, that makes that decision a little bit easier to swallow, is that basis has improved quite a bit in quite a few areas. Now, there's going to be those areas that, maybe North Dakota specifically, where your market is taking your soybeans on the rail west to the PNW for export. Without that export channel, your cash market's going to continue to be soft. So the decision is, okay, if I can't store the soybeans myself, do I again bag them and risk spoilage? That's a one option that you have. There has, like I said, in a lot of areas there has been some short-term basis improvement, which has been one of the real negative parts about the soybean cash market. So that might be something where if the basis is improved, you can go ahead and sell those soybeans. Maybe looks a little bit better than it did 2 to 4 weeks ago. Again, if there is concern or the desire to participate in a market, should there be a South American weather event or a trade deal that is reached, you can use some type of a call to participate in what the futures might do if one of those two things happens. But also something I would suggest is that if you do have your own storage for soybeans, and this is one of the things I wanted to bring up. This is a chart of the November to January soybean spread. So the green is last year, and essentially this is the amount of carry that the market is offering you to store soybeans from November to the very next month of January. The yellow is this year. And so I think it's interesting when we look at the pace with which we've come off the lows in the spread over the last several days, with also some of what we're hearing in the cash market. CIF values yesterday were 71 over November in the morning. Then in the afternoon, they were 80 over. We heard COFCO St. Louis was bid 4 over November in the morning, and then 16 over November in the afternoon. So, and COFCO is that state buying arm for China. So there is some speculation that China is actually in the market under the radar right now because we don't have government reporting due to the shutdown. So if there are export sales that are being accumulated, we're not going to know about it unless there's some other clues to tell us. And so the basis changes and the changes in the spreads might indicate that China's actually in here while the government is shut down, accumulating some soybeans. You could call that maybe a goodwill gesture prior to the APEC summit, where we're going to have Trump and President Trump and Xi Jinping meet, and for China to be able to say, hey, we bought some soybeans ahead of this meeting as a goodwill gesture. Would you like us to keep these purchases on the books or cancel them? That could be a bit of a negotiating tactic for them, several weeks down the road. So I know we've kind of addressed a lot of things here, but maybe the thing to think about for the producers, if I am going to store soybeans, how do I lock in the carry? Because this carry could very quickly evaporate. And if you intend on storing the soybeans and the spread narrows, it's very quickly going to tell you to not store soybeans anymore if the carry goes away like it did last year, right? So then that's the market telling you it wants the soybeans now. Here's the same look at corn. So this would be December 24 corn to March of 25. That would be in green. And then the D's 25 to March of 26 in the yellow. So I think it's really interesting that as big of a crop that we've talked about this year, with the idea of how large the carryout could be, and yet the carry from December to March has not reached levels that we saw last year at widest points, and we're starting to narrow in at a little bit more rapid pace than we were last year as well. And so I think the other part of these spreads is when you see the month one, month two spread, which is what we looked at in here in corn, and then in the last slide in beans. When you see these spreads narrow, that really is indicative of probably two things: real world demand coming in, and the other part of it too is potentially there are a lot of bushels that have already hit the elevator system, and the commercials may be looking at this saying, "Hey, we can't wait around very long to lock in the carry. We're going to carry the corn and we're going to carry the beans. We need to lock in the carry." Because if this carry evaporates, that takes dollars out of the commercial program.
Fantastic. On to our next story. Oil prices declined yesterday as geopolitical tensions eased and inventories increased. Brent crude fell below $66 per barrel, while WTI hovered near $61.50 per barrel, both falling roughly 1%. The decline followed President Trump's announcement that Israel and Hamas had reached an agreement to release the remaining hostages held in Gaza. Additionally, U.S. crude stockpiles increased for a second consecutive week, though they remain near seasonal lows. Oil prices continue to face downward pressure amid expectations of higher supplies from OPEC and its allies. Analysts are forecasting a market surplus in the coming months, with Goldman Sachs projecting Brent to average $56 per barrel next year. What are your thoughts on the current decline in oil prices and the possibility of prices falling below $60 per barrel?
Right. So the way that the crude oil market has been trading, and we'll maybe focus on the December contract here. That's where the volume and the open interest. Well, the open interest, the volume still in November for a little bit, but December crude oil has not traded below $60 a barrel. You'd have to really go back to about the beginning of June. And we traded, below 60 there before a brief run up to just above 70 in late June, and that was as we were kind of getting a lot of the geopolitical tensions going on with Iran at that point. And so, what I would say is that we've tested $60 numerous times. Every time we bounce off of 60, the bounce gets a little bit more and more shallow, and so that's generally not a good sign. If this market were to eventually break down below 60, I think we would have to refer to this as a descending triangle, which means you basically have a downtrend and then a flat base of support below the market. And if we do eventually break down below 60, then that probably means we're going to see a push down to what I think would be the next major support down around 45. You should have some minor support around 55 with some short-term lows that were made after the tariff announcements, at the beginning of the first quarter. But I think the fact that we have the tensions, hopefully, the war in Gaza, if we can reach an agreement here, number one, that's the best thing. I've been in war before. I don't wish it on anybody, especially when I think about kids in a war zone. It's absolutely horrible. So if this can come to an end, then that's a great outcome. But I think there's a lot of other things going on in the energy sector. It seems like there was an immediate reaction to this, but I think the crude oil has come off the lows, and I think there's some other things as far as the general money flow of the market, the inflation that we're seeing in some of the outside markets like metals, and what OPEC is doing with their production, which I think their cuts were less than what the market was actually thinking they could be, which provided some support.
On to ethanol. Production rose to a seasonal high last week. Weekly output of 1.07 million barrels per day was up 7.6% compared to the prior week and up 5.5% versus the same week last year. Ethanol stocks were slightly lower on the week, falling to 22.7 million barrels. The print was down slightly compared to the previous week and down 3.2% compared to the same week last year. According to Reuters data, U.S. ethanol margins remain strong. Brian, what is your take on this data?
Anytime production is up prior, versus the year prior, yet stocks are down versus the year prior on a week-to-week basis, I see that as positive. That gives us, a general, at least short-term positive outlook to corn for ethanol as far as on the demand side of the balance sheet. This isn't the best year we've had, but this is definitely a year that's running at the upper echelon of ethanol stocks here. I mean, it would be nice to see a drawdown in ethanol stocks to really warrant some more aggressive production of ethanol and more corn usage. But overall, it seems to me like, in general, everybody that touches a bushel of corn right now, from the usage standpoint, is making money from it.
On to the Federal Reserve. So the outlook for further interest rate cuts remains uncertain. Minutes from the Fed's September meeting show that most policymakers believe additional rate reductions will be necessary this year. However, officials face conflicting economic signals, with inflation proving persistent, even as the labor market shows signs of weakening. Based on the median projection, policymakers anticipate 2 more quarter-point cuts by the end of the year. The markets are pricing in rate cuts both this month and in December. In your opinion, how do you think the Fed is going to handle this sticky situation with a weakening job market and then also inflation remaining high?
Well, I think the market is telling us that the focus from the Fed is going to continue to remain on the labor market. And I say that because of how some of the precious metals are trading, and there does seem to be kind of a major inflationary move outside of the grains. And sometimes inflation starts, and certain products see the inflation first, and then other markets that may go up.
Oh, there you are.
For a second there. Some other markets might go up the idea of the rising tide lifts all boats, but they have some kind of bigger picture, bearish fundamentals that they need to work through first. But as far as the Fed goes here, they already told us that their decision-making process is going to be based more about the labor market and less about inflation. So I think that that's still their primary focus. And if they are concerned about the labor market, they are going to continue to lower interest rates. Now, inflation is still something they're going to keep an eye on, but it seems to be on the back burner. And so, I think that change in their attitude, the change in their tune, is what's led to a lot of the money coming into the precious metals, for example. I think there's a major event taking place right now with gold, silver, palladium, platinum, and we'll probably get to that in a little bit.
Right. So that leads us to
right now.
Yeah, here we are. Gold and silver surged to record highs on Wednesday. Gold surpassed $4,000 per ounce for the first time, while silver reached a new all-time high of $49.57 per ounce. The rallies were fueled by geopolitical tensions, expectations of interest rate cuts, and the ongoing U.S. government shutdown. With safe haven demand remaining strong, Goldman Sachs projects that gold could climb as high as $4,900 per ounce by the end of next year. So far this year, gold has risen more than 50%, while silver is up more than 70% year to date. Do you want to elaborate on this situation as you just were?
Yeah, right. So there's multiple elements to this. The government shutdown is one of them. I think there's a general talk about de-dollarization. Obviously, there's been a system that's been in place, right? The petrodollar. Saudi Arabia, produces crude oil. They're pricing it in U.S. dollars. So is that system something that's going to be in jeopardy in the big picture? We look at the government shutdown. That's bringing concerns. We've talked about the inflation, the Fed changing their focus as far as monetary policy decisions to labor instead of inflation. So again, that kind of gives investors the green light to say, okay, the Fed's not worried about inflation, at least not as much as they are the labor market. So we can buy things and inflate it, and it's not going to be their primary concern. Now, the other thing, it's interesting. Yes, you just had gold go over 4,000. To say, oh, we could go to 4,900 sometime next year, like, no kidding. This market can go up $100 a day, and that's not even as a percentage that big of a move. I have a feeling that when this thing ends, and it will end at some point. We're going to see it go parabolic, and you're probably going to see a day where gold is up several $100s an ounce in one session. You might see a day where silver is up, $6, $7, $8 an ounce in one day before this thing turns. I think there's going to be an absolute massive panic type of a blow off move when it's done. And I don't think 4,900 is even close to where it's going to top out. I think it's probably going to be substantially higher than that. There's too much mania going on right now. There's too much buy every single dip in the metals for this thing to end quietly.
Alrighty, before I let you go, cattle futures had an impressive day yesterday. Live cattle were 75 cents to 202 higher. Feeders saw gains ranging from $4 all the way up to 605. Brian, do you have any cattle market thoughts here this morning?
The cattle market's been moving in a pattern very similar to last quarter. And basically, you see buying come in at the beginning of the quarter. We saw that at the beginning of July. It ran higher. It was a period of roughly 2 months straight. Then the last month of the quarter, we consolidated. That was basically what we did from April to June. Then we did it from July to August. And so now at the beginning of October, we've kind of broken out to the upside. We've seen some new contract highs in feeders. Feeders do seem to be leading the move here. The setup technically is the same. That would suggest that we could potentially see a whole other leg higher in the cattle market for the next 2 months. And hopefully that is what comes to fruition. But again, we have to be mindful of the patterns and the way that they look like they're continuing, but also we have to be mindful if these patterns start to change. And I think something else I want to mention is I think it's somebody else's birthday today. It's not just mine, Mackenzie.
Golly,
George Kittle's.
I think that might be it. Yeah.
George Kittle's birthday.
George Kittle. Yeah, definitely.
Is there somebody else?
Goodness sakes. Does anyone else come to mind for you, Brian?
I don't know. I think it's Joe's birthday, isn't it?
Is it Joe Vaclavix?
Yeah. I read in the comments somewhere that he was in jail for like 4 days.
Yeah.
People were speculating. And
I saw that too. He got in a bar fight.
Yeah, maybe it's just his birthday.
Yeah, maybe it is. Who knows? I don't know.
We'll time with his family. It might
we'll
be
have to
something
confront
simple like that.
We'll confront him about that next week.
Okay, sounds good.
Okay, perfect. Thank you for joining me this morning, Brian. I hope you have a fantastic birthday. Everyone have a great day, and we'll see you guys tomorrow.